Hey, it's Darius Clark from CPAExamTutoring.com, home of the I-75 CPA Review course. And don't forget about the I-75 Scholarship Program. Come to the website, click on Scholarship, and you can apply for an I-75 Skinny Bundle Scholarship. I know what you're thinking. You're like, I'm never going to win a scholarship. Well, take a look at the list of winners that we've had just since March. And you can hit some of these people up on LinkedIn and ask them if they expected to win, because they probably didn't, but they applied anyway. Now in part one, we looked at cash basis to accrual basis revenue. Now we're going to look at cash to accrual basis expenses. Cash basis expenses equals cash paid. Accrual basis expenses equals what was incurred. The exam, they'll give you the cash paid, and you're going to have to determine the expense incurred and when would it be different? And the answer is accrued liabilities. When we incur expenses this year, but pay them next year, that's called accrued liabilities or accrued expenses. For example, let's say employees earn $1,000 per day and they get paid every Friday. And let's say they worked Monday, December 30th and Tuesday, December 31st, but they're not going to get paid until Friday. So for those 2 days they worked, and then the year ended without them getting paid. So as the employer, we incurred the expense this year, we'll pay it next year. So for those 2 days, we'll have to debit wages expense for $2,000 and credit wages payable for $2,000. And that's an important adjusting entry made under accrual accounting rules at year end. And it involves one income statement account and one balance sheet account. And you can see that if you fail to make that entry at year end, that would understate expenses under accrual accounting rules, and that would overstate net income under accrual accounting rules. So if you didn't make this entry at year end, the exam might ask you what's the effect on net income, and you'd say net income would be overstated because expenses would be understated if you failed to make this entry at year end. And some companies might just be lazy and not make this entry because they're going to pay the employee a few days later when Friday comes along again, but that's going to be in the next accounting period, and they'll credit cash for the 5-day work week, they'll turn around the payable, and they'll have an expense for the Wednesday, Thursday, and Friday. So with accruals, accrued expenses, accrued liabilities, it's income statement this year, cash next year. So why are we recognizing this expense at year end? Because it was incurred this year. It won't be paid until next year, but it was incurred this year. So an accrued expense or accrued liability, income statement this year, cash next year. So you need to know about this $2,000 wages expense. It was incurred this year, it'll be paid next year. Why is that important? Because if they give you a question like this, and they say how much is accrual basis salary expense for the year, and they start out by saying company pays employees $200,000 in salaries during the year, so that's the cash basis expense, and then they say that at year end employees had not been paid for 2 days at an amount of $2,000, so that means you incurred $2,000 more in the current year. How much is accrual basis salary expense for the year? And the answer would be $202,000. So you paid $200,000, but you incurred $202,000. Letter B would be the answer. Here's a little like what you'd see on the exam. Company pays employees $200,000 in salaries during the year, so that's the cash basis salary expense. Then they're going to say at year end employees had not been paid for 2 days at an amount of $2,000. So that means you incurred another $2,000 at year end on top of what was already paid. So you're up to $202,000 for accrual basis expense. But the beginning balance of salary payable was $500. So salary payable began the year with a $500 balance in it. Well, that $500 was actually incurred last year and was only paid this year. So you're going to subtract the $500. So how much is accrual basis salary expense for this year? Letter A, $201,500, right? Because $200,000 was paid this year. $2,000 was incurred this year, paid next year. So we added the $2,000. $500 was incurred last year, paid this year. So we subtract the $500, we get $201,500. That's how much is incurred this year. That's the accrual basis salary expense. Notice that we're working in expenses, not in revenue. Our starting point is an expense figure, not revenue. See, in the previous video, we were all about revenue, going from cash collected to revenue earned. And we would say, when was it collected? When was it earned? Now we're saying, when is it incurred? When is it paid? So if you're working with expenses, I want you to think in terms of when was it incurred and when was it paid. So the $2,000 was incurred at the end of the current year. So add that. That's this year's expense. The $500 was incurred last year. It was only paid this year. So if you want to know how much was incurred this year, you would start with the $200,000. You'd add the $2,000 incurred this year, paid next year, and you'd subtract the $500 incurred last year, paid this year. And that's where we get 2015.
Therefore, accrual basis salary expense is 2015, answer choice A. And that's the kind of question you got to be ready for. Okay, so you got to be able to go from cash basis expenses to accrual basis expenses. So you could see this in auditing too, but certainly in FAR for adjusting entries. Your cash paid for salaries this year, $200,000. Add what was incurred this year, but paid next year, those last few days where they worked and didn't get paid. That's an additional expense under accrual accounting, $2,000. Then you'll subtract last year's accrued expense that was paid this year, that's $500, and this year's accrual basis salary expense, 2015. Now, when it comes to cash basis expenses and accrual basis expenses, interest is another biggie. Because if cash payments for interest during the year were $50,000, that's what you paid, but you made this entry at year end, debit interest expense $10,000 and credit interest payable $10,000. What does that mean? That means you incurred it this year, but you're not going to pay it until next year. That's got to be included in this year's accrual basis interest expense. So if cash payments for interest during the year were $50,000, then the ending interest payable balance of $10,000 needs to be added to cash payments for interest to determine accrual basis interest expense. Even though it was incurred this year, it's going to be paid next year, but we have to include it because this represents the passage of time for interest, right? Maybe the bonds were issued at a certain date, and although the interest isn't being paid as of the end of the year, this entry is of year end. It's going to increase your interest expense, and you're going to wind up with accrual basis interest expense of $60,000. So assuming this is the first year and you had no beginning balance of interest payable, then you're going to have cash basis interest of $50,000, accrual basis interest of $60,000. Now I know what you're thinking. What if there was a beginning balance in the interest payable account? Say $3,000 was the beginning balance. This would represent the amount incurred at the end of last year and paid this year. So then you would subtract it from the $50,000 that was paid this year, because we want to know what was incurred this year as interest expense. What was incurred this year was $50,000 minus the $3,000 that was incurred last year, plus the $10,000 that was incurred this year and won't be paid until next year. So then interest expense incurred under accrual accounting rules would be $57,000.
Now what they might do on the CPA FAR exam is they might give you a T account like this for interest payable. And they might say that $3,000 was the beginning balance of interest payable and $10,000 was the ending balance of interest payable. And they might ask you how much interest expense was incurred during the year if $50,000 in interest was paid. So you have $50,000 cash interest paid. The beginning balance of interest payable was $3,000. The ending balance was $10,000. And we can see that the $10,000 ending balance represents interest expense this year, going to be paid next year. So that $10,000 is not already in the $50,000 paid, but since it was incurred this year, you would add the 10 to the 50 and get $60,000. But then the $3,000 beginning balance of interest payable, when was that incurred? It was incurred last year.
paid this year. How do you know it was paid this year? Because the beginning interest payable balance should be paid within 30, 60, 90 days, right? It's a current liability, so it should be paid this year. So it's in the $50,000 of interest paid, but when was it incurred? It was incurred in the previous year, so subtract the $3,000. So subtract the $3,000, add the 10, and how much interest expense incurred for the year? The answer would be $57,000. So cash basis interest expense $50,000, but accrual basis interest expense $57,000. And that's how much interest expense was incurred during the year, $57,000. So be ready to solve this either with a T account or, like on the previous slide, without a T account. If they just tell you that cash payments for interest were $50,000 and $10,000 was incurred at year end, so that's why we added the $10,000, the ending interest payable balance of 10, we added that because that's an expense incurred this year, paid next year. Then that beginning interest payable balance of $3,000, what does that represent? That's last year's ending interest payable balance. That would represent the amount incurred last year, at the end of last year, and paid this year. So that $3,000 beginning balance of interest payable, that was paid this year, but it wasn't incurred this year. So that's why we're taking out the $3,000. So we'll add the ending 10, we'll subtract the beginning $3,000, and that's why the accrual basis interest expense is $57,000, even though the cash basis interest expense was $50,000. So if a current liability like interest payable goes up from the beginning of the year to the end of the year, an increase in interest payable means more interest incurred this year than paid this year. So an increase in payables means more expense incurred than paid. And we can see that interest payable went up by $7,000. That means you're going to have incurred $7,000 more in interest expense compared to what was paid on the cash basis. Cash basis interest, $50,000. Accrual basis interest, $57,000.
All right, let's try this question. The Flagler Corp paid $62,000 in interest for the year, so that's cash basis interest. The interest payable account was $3,000 at year end and began the year with $1,000 in interest payable. So what do they want you to know? How much interest expense was incurred for the year? So you paid $62,000. How much is incurred? So the cash basis interest, $62,000. How much is accrual basis interest expense? Let's get a look at the beginning and the ending balances, and how did that help us solve this? Well, you could say that the $1,000 beginning balance, that's last year's accrued expense at year end. You incurred that $1,000 last year, you paid that $1,000 this year. So the $1,000 is already in the $62,000 figure because it was paid this year, but it was incurred last year, so it's not this year's expense. So take the $1,000 out of the 62 because you don't want to know what was paid this year. You want to know what was incurred this year. What's the interest expense incurred this year? And the $1,000 was incurred last year. So take the $1,000 out, you're at $61,000. The $3,000 interest payable at year end, that was incurred this year, and it won't be paid until next year. So for that reason, we're going to add the $3,000 to the $62,000 because the $3,000 is this year's expense, and it's not already in the $62,000 because the $62,000 is only what was paid this year. So we want what was incurred this year. So add the $3,000 because that's this year's expense that we'll pay next year, and the $1,000, that's last year's expense that was paid this year. So we take away the $1,000, and that leaves us with $64,000, which is answer choice B.
So here's the T account that would go along with this last question. So you see how interest payable began the year with a $1,000 credit. So what is that? That's last year's expense for interest at the end of the year last year. So that's last year's expense paid this year. So that $1,000 is already part of the $62,000 that was paid this year. But it wasn't incurred this year, so take it out. Take the $1,000 out because we want to know how much interest expense was incurred this year. So 62 was paid, 1,000 of it was last year's expense paid this year, so take out the 1,000. Now the 3,000 ending balance of interest payable represents this year's expense at year end. What's expensed at year end this year but not paid till next year. So on an accrual basis, you would add 3,000 and you'd wind up with 64,000. Now notice that interest payable went up by 2,000 from beginning of the year to the end of the year, and whenever the interest payable goes up, whenever payables go up, that means you have more expenses incurred compared to what was paid. So you paid 62,000, but you incurred $2,000 more than that. So your accrual basis interest expense is 64,000. So what you should do is take a question like this and just make up your own numbers and see if you can solve it. Change one number here, one number there. That's what I call the finer points of studying for the CPA exam. So if you have 62,000 in interest paid for the year, and if your beginning balance is 1,000 and your ending balance is 3,000, change one of the numbers and see if you can solve it. See if you can get the right accrual basis interest expense. Knowing that if the interest payable goes up, like it did here, that means you incurred more in expense than you paid. But what if the payable goes down? If the payable goes down for the year, then you would have paid more than what was incurred. Let's do the same question again, but we're going to change one number. Let's see what number is going to change. So Flagler Corp paid $62,000 in interest. That's what they paid in cash for interest. But the interest payable account was $3,000 at year end, just like it was before. But it began the year with $7,000 in interest payable, not $1,000. $7,000 beginning balance. How much interest expense was incurred for the year? All right, let's look at the T account. So we started with $7,000 at the beginning, and the ending balance is $3,000. So we have a $4,000 drop in interest payable. That means we paid more in interest than what was incurred. Because when payables go down, why do they go down? Because cash went down. Because you took cash and you paid off your payable. So because interest payable dropped by $4,000, that means you paid $4,000 more in interest than what was incurred. Now they told you that you paid $62,000 in cash for interest, so you must have incurred only what? $58,000, which happens to be answer choice D. So if you can do things like this, change one number and see if you can solve it, that's the finer points of passing the CPA exam, because that's what the exam's going to do. They know the question that you've studied because they released it and everybody studied it and memorized it. But can they solve it if one or two numbers changed? If just one number changes here, the beginning balance being 7,000 instead of 1,000, now you have a drop in interest payable instead of an increase in interest payable. What does that mean? Well, if payables go down, why do they go down? Because cash went down. So that means 62,000 was paid during the year. If payables dropped, that means you paid more this year than you incurred for interest by $4,000. So you paid $62,000, you must have incurred only $58,000. Another way to look at this would be to say that you paid $62,000 in cash, and then that $7,000 beginning balance is in the $62,000 because it was paid this year, but it was incurred last year. It was last year's ending balance of interest payable. So that $7,000 was incurred last year. So subtract the 7 from the 62 and you're at $55,000. But then that $3,000 ending balance of interest payable, that's incurred this year. So that's this year's expense. So add that and you're up to 58,000.